Welcome, everybody. My name is Chris Roberts, CEO and founder of Sterling Rhino Capital, and Rob Lutine, who is our asset and underwriting manager, director, you name it. He's got lots of titles. And Paul, who's co-founder, as well as one of our underwriters with Sterling Rhino Capital, on the call today. And we want to talk about how you can retire early using the multifamily real estate investing vehicle. If you don't know much about real estate syndications, the primary goal is for us to educate people and just show them that there is another way outside the stock market, which is what most of us are taught. And we educate. We have a great YouTube channel, email lists, Facebook, and the website that has a lot of blog content on it. So if you just want to learn a little bit more about multifamily real estate investing, particularly the passive side of it, where you don't have to swing the hammers, you can just sit back and be the beneficiary of higher than average returns, you can jump on any of those platforms and learn more. Today, what we're going to talk about more specifically is how do you calculate what you need for retirement, and what does that mean? There are lots of levels to retirement that we have to think about, be it, how do I get there? What time frame? What are some of the concerns and questions you might have when you get there? How do you set yourself up financially now before you get there? And then what are some of the vehicles you can use? And you can use single families, multifamilies, stock market, and all kinds of other things. But we really, really like the multifamily space. So what we're going to do is I'm going to turn the screen over to Paul Wilcox, and he is going to pull up our early retirement calculator, and we're going to run through some fun exercises just to show you the power of real estate and what it can do for you. And then we will end with some Q&A and maybe ask somebody if they want to give us an example of how they would like to retire, and we can plug their numbers into the calculator. So Paul, if I stop screen, can you take over?
Sure. All right.
Cool. All right.
This is our passive investor income and retirement calculator. And this uses the standard returns found in multifamily syndications, and that Sterling Rhino, the returns that we look for in the properties we buy. It uses those returns and projects that out over a specified duration period. And it allows you to customize a plan for yourself over the next 10, 15, 20 years, whatever your timeline is, and can give you a real plan for what you have to do using this vehicle to reach a passive income level that allow you to quit your job, retire, follow a passion project. Doesn't even have to be retire, just to that level of financial freedom. And I don't think enough people are really paying attention to what they're going to need when retirement comes. And we spend all this time just kind of building a nest egg. And I was doing that for the last 20 years. I was just like, well, I just hope I can amass enough money. And I hope that nest egg gets me for another 20, 30 years past retirement. But there was no real plan. And then I found multifamily, and I found the potential of passive income. And I was like, wow, this is the key. And these returns are consistent and they're reliable. And if you're disciplined and you follow a plan, this can really work. There's no volatility. It's very predictable. So this calculator is downloadable for free on our website. And a lot of people are a little intimidated by it because it's Microsoft Excel. And there's a lot of numbers when you first open it up that you're looking at. But I want to show everybody this is very simple to use. And it's really only a matter of tweaking 3 different numbers. That's it. And it's a combination of those numbers that you just keep testing, and to see when you could potentially retire early if you were to focus on using multifamily as your vehicle, that's say on top of your other retirement accounts or in lieu of them. And I chose the route to use this in lieu of traditional retirement accounts. I am in the process of completely liquidating everything that I put into my 401k over the last 20 years. And it's all going into multifamily because this is reliable. And as you will see in our examples, this will soundly beat the traditional retirement account. And when it comes to passive income, it destroys it. So I'm super excited about my future, and I want other people to get just as excited because this is real. This is not a Ponzi scheme. This is tried and true real estate. And most millionaires were built using this vehicle. And now it's accessible to everybody. So what I'd like to do here first is use one of us as our first scenario here. One of our partners, Rob. We're going to use him as our first guinea pig here as far as let's figure out when Rob can retire early. So the first thing is our investing duration period, this top cell here. Rob, how many years from now for you would you like to set this at which would be an early retirement for you?
Let's just go ahead and put in a decade, a nice little round 10 years.
Okay. So 10 years is our duration period. And Rob's thinking, well, if I can retire in 10 years, then that would be fantastic.
Basically.
Okay. Now, here is your year one initial investment total. And I know Rob has invested a lot in 2020 along with myself, and we're invested in a lot of the same deals. So why don't we treat 2020 as Rob's year one? And Rob, how much money did you invest in 2020 in multifamily?
I put in 700,000 in year one. I did what you did, but I did it a year early.
So Rob took a lot of what he had. I know he liquidated some other real estate investments, and getting this amount of money in early, because this is exponential growth, because it's a doubling of your money every 5 years on average. This will do wonders every time you go 5 years because it's a double and then another double. And then if we can go 15, it's another double, right? So that's an exponential growth.
Yep.
Rob, what do you want to plan on adding to real estate investments per year over the next 10 years?
I'm going to be optimistic simply because I'm also in this. So I'm putting in a minimum of 50 because Michelle's still working. So we still got a few expenses, but 50 grand a year continual.
Okay. So far we've plugged in 3 numbers: investing duration. We've plugged in your initial investing amount because a lot of people have more money up front, but then can't continue to contribute that amount every year. He's going to do $50,000 per year moving forward. And we're going to do this for the next 10 years. So there's 4 cells we fill out. This 700 is going to stay. So as we run scenarios here, we're only going to be changing potentially 3 numbers: your duration, your annual contribution, and the duration of your annual contribution. Rob, what is your baseline financial security number? This is the number you need in passive income to cover your basic living expenses.
For today, $10,000 a month.
Okay. So
it's
Rob
actually
needs
probably a
to
little
hit,
bit less than that, but I'm going to be a little bit nutty and go 10.
Rob needs to hit 10,000, and we call this financial security. This is just like your basic needs are covered. All right. This isn't going on luxurious vacations and buying Lamborghinis. But this is the basics. Now, let's see by hitting calculate if Rob is going to hit that passive income in 10 years. I hit calculate. As long as you see the green okay here, your numbers are good to go. And then we're going to scroll down. Okay. Down here below this line of potential income, this is where we can see how much income. This has nothing to do with net worth. This is the cash flow This is the passive cash flow that your real estate is generating for you in 10 years. So with Rob's plan, in 10 years and into year 11, he will be potentially making $15,500 per month in passive income. So obviously he has exceeded his financial security number. All right. So this plan will work for Rob. Actually, he could drop his investing annual contribution a bit if he's just got to hit 10. Let's say he can't hit the 50K a year and he wants to drop that to 30. Well, we just change that to 30. We recalculate, right? He's still near 14. So let's try the fun number. Rob, what is your financial freedom number? And this is true.
Yeah, I don't care
financial
about
freedom
anything.
where you don't
and
worry about money. You can do whatever you want.
oh, let's go ahead and just throw that up at 50. Why not?
All right. So this is where you can kind of just play with it. Your financial freedom number is I've got enough passive income coming in where I can live a life of luxury or complete freedom. Rob's going to say that's $50,000 a month. So the 700 we got to leave because that's year one. That's a static number. Now it's a combination of time and additional contributions. It's only those two numbers. You can either add a combination of both or one or the other. So we could bump this number up to 15, right? And just do that, right? He's now at 28, almost $29,000 a month. I would say he probably wants to keep this at 10. Rob's like, all right, what do I got to put in per year to hit $50,000 of income over the next 10 years?
That just blew it out of the water.
Right?
Mm-hmm.
So you're at 20,000
20.
because this 100 is being spread out over the next 10 years.
10
So the
years.
100,000 you're putting in year 9 doesn't have a whole lot of time to work,
Nope.
right? So it might
Bump
be a
that up to
combination of the
15.
two.
Put the top number to 15.
If we put this to 15, well,
41.
Rob's almost there, right? He's broken 40. Let's add a year to this, and let's make this 125.
Yep. There it goes.
We blew it out. I want to see what 16. Yeah.
51.
16 years, if you can put 100. Now, Rob might not be able to do this, but this is the fun number to play with, right? He could also, you can just play with these numbers and figure out what works for you. So that's pretty much how it works.
Hey, Paul.
And yeah, go ahead, Chris.
I just wanted to, so this calculators are amazing to kind of figure how you can get to this, this incredible number, right? This audacious 50,000 a month, or even the $5,000 a month. Either way, you can plug these numbers in. But what I like about it is, let's scroll back up real quick, Paul, just in this scenario, and then I'm gonna let you go back into what you're gonna say. But I want to just highlight something here that's kind of neat. So let's just say and we're gonna get to this a little bit later about how you can actually invest with IRA money, maybe you got a retirement account that's sitting there that's from a previous job or something. Let's just pretend you had $1 million in that account, and you don't have a lot of capital because maybe you're getting perhaps a little bit older and you don't have as much disposable income. Maybe you do, but let's assume you don't have as much, but you do have 700,000 that you put in, whether it was capital, inheritance, or retirement money, let's say today, and you aren't going to retire for 10, 12 years. Well, if you had an IRA that you weren't using, you can actually use that money to invest in multifamily. So let's just say each year you converted a chunk of that over and invested that in multifamily. And that's how you were able to invest 100,000 each year for the next 10 years. You just took retirement money out of an account that maybe you weren't using or was actually being transferred over into a more conservative fund, because as you get older, the risk, you start mitigating the risk by transferring from riskier funds to, bonds and things that, are not as volatile as you get closer. So maybe at that point you say, this first year I'm going to take 100,000 out of there and I'm going to transfer it into a multifamily asset. And the next year I'm going to take another 100,000. I'm going to transfer that into an asset. So maybe you don't have 100,000 in disposable income. Maybe you have half, but you could use retirement accounts as well through different vehicles EQRPs or solo 401ks. There's a bunch of stuff, self-directed IRAs to actually achieve this. So as much as it seems audacious and crazy to put 700,000 in and then go down to the bottom and see this number of 50,000, it is actually possible. And here's one realistic scenario, just again, off on a tangent, but I think it's relevant. Just if you think about it, 10 years, 100,000 each, that's $1 million, right? And then 700,000, that's only 1.7 million. Now that's a lot of money, but there are lots of people that throughout their careers have built $1 million, $1.5 million in their retirement portfolios. The challenge is once they get into retirement and they're living off that retirement, those returns are pretty small and from a cash flow perspective when compared to real estate. And you could see here by just putting that 700 and putting 100,000 per year for 10 years in, that number's 51,000. I'd be willing to bet that as a retirement cash flow without any real estate, it would be a third of that if you were lucky, right?
Look at ours over the side here. I mean, over here is the traditional retirement account using a 7% compounded annual growth rate and a dividend yield of about 2.5%, which is like an average mutual fund dividend yield. And your monthly income is just above $9,000, right?
There you go.
And your net worth, you're at about 4.5 million. Look at real estate. Your net worth is 10 million and your income, which is really the important number, is 51.
It's absolutely
Right?
incredible.
5 times
Yeah.
your dividend yield in typical retirement mutual funds.
It's incredible.
ETFs.
And so a couple of things to just take away from here before Paul goes into the next scenario is, first of all, full disclaimer, we're not CPAs, we're not real estate attorneys, but we all as a collective group invest passively in these asset classes. We obviously syndicate deals with limited partners. So we build out these deals with other people. And so we have experience in it. So we've actually seen the types of returns you can get. We never guarantee anything. Like anything, there's risk involved and there's ups and downs. But the nice thing about this asset class is that you control in general the way it's going to perform when you buy the asset, because you underwrite it so that you know, okay, we're going to hit a minimum, we're going to hit a maximum, and then maybe you come somewhere in between. But you're very conservative in the way you underwrite. Whereas with stocks, you put the money in each month and you really have zero control over how that money performs for you as it's in that asset class. And so again, we're not CPAs. We have CPA on our team actually, and we deal with, I think, 4 or 5 of them throughout our portfolio, but and they've all vetted this and looked at it, and the numbers are real. And these don't even account for the tax advantages in real estate, these calculators. But we just like to highlight a realistic scenario, someone that has a little bit of capital in an investment portfolio, and they're thinking, well, this is all I get is my 5 or 6% returns after my asset management fees in the stock market. No, there is another way. And there's a way you could even use some of that money to invest in real estate if you don't have a significant amount of cash. And if you want to learn more about that, we put in the chat, you can text Rhino to 66866 and you'll automatically be set up for all kinds of cool information that we send out about this asset class. Or you can check out our website, YouTube channel, or any of that. But that's all I wanted to say. I just wanted to touch on that. This calculator is amazing. Paul's going to continue. He's going to come up with another example that might fit somebody who maybe perhaps doesn't have that kind of capital to invest. But I just want to highlight the power of it, specifically as it relates to using retirement money to invest in there. So thanks, Paul. Go for it.
Got it. Does anybody on the call want to plug in some numbers for themselves to have a little bit of fun? Maybe reveal if you can retire in 9 years from now. Should be fantastic.
Does
If not,
anybody have a retirement number? What's the retirement number, the cash flow number on a monthly basis or an annual basis that you need in retirement? Does anybody want to throw a number out there?
I'll do 30, please.
okay.
Alex, I'll take 30, please.
30. Whew.
All right.
You must
So
be in Southern
30,000
California.
sounds fantastic. And,
I need to get out. I need to get out.
and hopefully cash tax-free 30,000 too, man. As long as the depreciation stays around. Okay. So what would be
So we have $1 million on that initial investment, $1 million on that.
Okay. And what would be the duration that you would consider to be a early retirement? What would be ideal? How many
I'll
years
take
from now?
5 years, please.
Okay, 5 years. And I do know, because I've played in this calculator so much and built it myself, that one more year beyond 5 is actually a big difference because of our average property hold of 5 years. In year 6, there's things that are selling. However, we could, this is just an average. We could sell properties in 3 years and make the same returns, or 4. So let's start with 5.
I'll take it for 6, please, Alex.
Okay. We'll go for 6. And all right, I'm going to change the duration to 6. And do we want to add anything to that over the next 6 years?
I'm going to keep it at 100, please.
Okay. The magic number is $30,000 a month. No whammies, no whammies. Okay. So in 6
no.
years, we
I'm
are
only
just
at
about half
15.
that. It's about $15,000 a month in passive income.
Okay.
However, your 1.5 million has nearly doubled, right? The reason it isn't a true double in 5 years is because we're actually applying a little bit of taxes here. We're putting a 50% tax on profits from sale, which lowers it a little. So we're just under 3 million. So we got to toggle these numbers a bit. We could either extend our duration or we could extend our average annual contribution. Which direction do we want to go?
I think we'll have to go to 10, please.
Let's see what we can do in 10 years with this same plan. And we're just at about $25,000 a month. All right. Which for
That'll
most
work.
of us, I think would be a plenty financial independence anyway.
Yeah.
Maybe not the true freedom, but in year 11, I wonder if it does it. Hey, 32.6.
I love that. Thank you.
You're very welcome.
That you guys, that is really great.
Yes.
Yeah, it's a nice little snapshot into the power of it. And these numbers seem pretty high. I mean, if you talk to somebody who's not used to real estate, these numbers can seem wild, like 32. How could I possibly? And of course, maybe not everybody has 100,000, but it's the type of returns, the type of obviously tax advantages that again we don't fully account for, but and several other factors that just I know sometimes it's alarming, but it's there. Unlike the stock market, which I think most of us have probably played in the stock market a little bit, and you've seen those returns, they're just not even close. So when Paul's done here, I want to give a little more, I guess, blue collar example, if you will, like an amount that's a little lower in
now
income.
that cash on cash could be higher depending on the opportunity that
Sure.
maybe you're already in.
Sure.
Those cash on cash returns are coming down, as we all know. So
Absolutely. Yeah,
And
there's
this
many
does not-
variables. Go ahead.
And this does not take into the tax advantages that some people can get.
Right.
Yeah. I mean, our tax rate on distributions is at 0 because of depreciation. And, as long as things keep going the way they are, as far as tax advantages, you shouldn't have to pay taxes on your cash flow. So that's why we have this set to 0.
Yeah, you get to carry it over year after year.
That's right.
let's hope that bonus depreciation cost segregation continues as well.
Let's hope. If
Yeah,
not,
I think
we'll work around it.
I think there'll still be some advantages. So that's good. Paul, can we use another example real quick?
Yeah.
Okay, so let's say, I make $75,000 a year, and I have $50,000 saved up, whether it be cash or retirement. Let's just assume it's 50,000. So
Which is your minimum to get into a deal.
Yep. And then let's just say I'm going to contribute $12,000 a year, so $1,000 a month for let's say 15 years. I'm 35. I want to retire at 50, let's say. Let's just see what that looks like.
15 years.
Okay. So 4,000 is the number, right?
You're at $4,000 a month in passive income just from real estate. You're 200, and now you've only invested a little over $200,000 over those 15 years. So not, you know, it takes a little discipline, but not a huge amount of money. And your net worth at this point, some of it's tied up as equity in real estate, but your net worth is at, $843,000 from that 218. And you can do a quick comparison over to your 7% compounded annual growth rate. I mean, it's not even comparable. Your monthly income here is under $1,000.
Right.
It's 4 times what your traditional retirement account will get you in the same time period.
Which is pretty amazing, because when you consider the average person has, maybe just a little, depending on the age bracket, but in retirement generally, a little over $100,000 in their retirement account, which is really astonishing considering if that money was invested throughout the years in higher yield investments like real estate versus maybe a little more conservative being the stock market or even specifically bonds. You might be able to increase your cash flow and or your net worth in a pretty short period of time. I mean, if you think about it, if you're in your 30s, let's say, and you want to retire early at 15 years, I mean, $4,000 a month in cash flow is significant. I mean, Social Security, if you even have it, might pay you, $2,000 to $2,500 a month if you're lucky, or less. And here you are, almost doubling that in just passive cash flow. The key, I think, is getting started. Can you come up with the 50,000 to start to get into most investments? Or if you have a significant amount earlier, like in Rob's example, even better, because the earlier you start with more, the more time, and then the way that money compounds will increase that cash flow. So pretty cool to be able to see, at $50,000 in with a 15-year duration and just basically $1,000 a month in investment, which, a lot of folks having money automatically taken out of their accounts, and even IRA accounts are putting in, $400, $600, $800, sometimes $1,200. I talk to people about that and they give me their numbers. That money could actually be converted over at some point and invested in this asset class and give you 2 to 3 times the type of returns. Now, again, those are all projections. We talk about doubling money. That's just what we see in the industry pretty consistently, give or take. But as anything else, things can happen, and some years can go up a little bit, some years can go down a little bit. But even during these crises with the crash in 2008 or so, the COVID situation, we did not see a huge interruption in distributions with these asset classes, which means, your returns are staying fairly consistent because all of that is based on income that's coming in, right? So just some things to consider. I think this calculator is really eye-opening, and I don't think a lot of people realize the power of what this asset class can do. I just wanted to highlight what it might look like for somebody who doesn't have as much capital. So thanks for that, Paul.
You got it. Chris, you want to run one more, or you want to wrap it up here?
I think we're probably pretty good. Are there any questions from anybody? Anybody want to bring anything up, say anything about the calculator or early retirement, or have any questions about multifamily, anything in between?
Sure.
If we wanted to, I'm sorry.
Go ahead.
Oh, sorry,
If we
go ahead,
wanted
please.
If we wanted to get this calculator or share it, how would we do that?
Yeah,
So-
go ahead, Paul.
You can go right to our website, and on the home page is multiple sections where it says get our free passive investor calculator, and you put in your name and email. So that's one way. The next way, if you look in the chat, Chris put up an even simpler way, and you could do it right now. You could text the word Rhino, RHINO, to 66866. Text Rhino to 66866, and you will automatically be emailed this calculator, all right, a link to download it. And then you'll also, be in our system and receive some educational content from us at the same time. So those are the two ways to get this calculator. You do need Microsoft Excel, obviously, to run it.
Cool. Thanks, Paul. So
Thank you.
I have taken over the screen now.
I think SK had something to say.
Yes.
So if I invest in the company, if I invest in your capital, I mean, in a Sterling Rhino Capital, and something happens in my life that I need the money immediately, how do I get the capital back?
That is a great question, and I'm glad you asked that. So the first thing, and is it SK? Am I pronouncing that right?
Yeah.
Okay. So I'm glad you asked that question. So the first thing is you're investing in an asset with Sterling Rhino Capital. So we're going in together. We're buying this building, right? We're investing as a syndication group. You guys are the LPs, and we are the GPs that are running the asset, which is great because you guys don't have to do the work, and we put in most of the work, and you get to utilize the returns. Now, if let's say generally the whole time is somewhere between 4 and 5 years. So let's say year 3, there was an event in your life where you said, I have to exit and I have to pull this capital out. We do have a vehicle that allows you to do that. And we would basically allow your shares to go up technically for sale to someone that's in the group, be it limited partners. So let's say there's 40 of them in there, or general partners. And if your shares sell, so let's say you put $50,000 in, and at fair market value, your shares were worth $65,000 because we forced appreciation on the building and so on and so forth. So we would allow a sale, if you will, of fair market value. And as long as another limited partner or GP was willing to purchase those shares, we would allow you to exit, no problem. If for some reason we could not allow, or let's say, for example, there was no one to purchase those shares, we would then open it up potentially to the market. But generally, if an asset is producing, they will, someone will pick it up. So that's kind of how it works. We haven't had anyone do that, but we do have that in our private placement memorandum, which is a really lengthy legal document that everybody signs, showing the risks and potential rewards and everything associated with these assets. And it's outlined for you there. So there is a way. Absolutely.
Not guaranteed. And, typically you want to try to use money that you don't think you'll need. It's like money that you normally would be saving for retirement. It's not emergency money. Make sure your emergency fund is there to cover emergencies in your life. Keep that full at all times. But there is a potential for an out down the road if you were to have an issue in your life.
Got it. So when did you actually start this Sterling Rhino Capital?
Where did it start?
No, when did you start?
Oh, just around, let's see, it was about, I think,
Fall of
19 months
18?
ago or so. Yeah, 19 months or so. And we all have different real estate experience. So we've been in real estate for some time individually, but we partnered up and created Sterling Rhino as a way to purchase the larger assets and bring more people together to buy these assets. For example, I had traded land, some construction, single family, duplexes, a little bit of larger multifamily, but nothing of this scale, 100, 200 unit buildings. Rob as well had quite a bit of real estate experience even in some of the larger asset classes, and actually was an underwriter for a really large syndicator group for years. Paul is a construction engineer. And so we all had lots of experience. We just realized in order to scale our business and to help others, we had to bring everyone together. And so that's now what we're doing. And during 2020, we closed 2 100-unit properties that are outperforming their performance so far. So pretty exciting stuff. This is not a new business model. This has been proven, and it's just one more way for someone to diversify their portfolio. We still encourage people to, invest a little in the stock market or maybe a single family rental or whatever works for them. But we found that this is a very powerful way to create higher than average returns and really mitigate the risk, because we can hire property managers, asset managers to run everything, and then we oversee it all. And then obviously with the scaling of all the doors, if you have certain vacancies, you can offset those vacancy losses because you have so many doors. So it's, in our opinion, it's just a lot less risky than getting into single families or the stock market. We really like the asset class. Does that answer the question?
Yeah, that answers the question. So yeah.
Cool. Wonderful.
Great.
Yeah. Well, thank you so much for asking the questions and joining. And as Paul said earlier, if you just want to learn more, you can hop on the website. It's actually, I've got it up here on the screen, and right down here is where you enter, or you just text. Either way, you'll get to the same thing. And then you'll get all these emails and information and links to videos and blogs. And you can opt out anytime, but there's a lot of really good information in there. Or you can just hop right on our YouTube channel and learn. And then if you're interested in an opportunity, you just hop on a phone call with me. We get to know you. And if it makes sense for you, makes sense for us, we partner up on the next deal that comes up, and you'll receive an email and a text message letting you know that there's an offering. And then we do a formal presentation on that offering. And if you're in after that, then we set up the legal documents and the money transfers and all of that stuff. But we hop on a call and get to know each other a little bit first, per the SEC and the rules. We do everything above board, and there's a particular process we have to go through with everybody.
Thank you so much.
Yeah, absolutely. No
You're
problem.
very welcome.
Cool. Well, hey, thanks everybody for stopping by. Again, this is Chris with Sterling Rhino Capital, joined by Rob and Paul, partners in the company. And we hope you gained some value from our presentation on the calculator. If you think there was good information in this, please share it with a friend. You can share the text to join as well. And we love helping and educating people. And if there's ever anything we can do, please reach out to us.
Have some fun with that calculator. Dream a little.
Thanks, guys.
See ya.
Thanks.